Hello everybody, welcome back. So in this video I'm going to do a review of best stock strategy. Now this gentleman, I believe is David, I'm probably going to say his last name wrong, but we'll just call him David. A young guy, very bright. He worked at a couple of investment banks, and we kind of found each other by commenting on other people's videos in a few situations where we both thought that there were some traders out there that were kind of scammy. And that's kind of how we found each other. But anyways, I wanted to do a review of what he does, and we did an interview, him and I'm going to play that interview for you in a few minutes, where we kind of had a little conversation back and forth. Now, before I do that, and we get into that interview, which will be about 37 minutes, where we're talking back and forth specifically about his style of trading, I want to qualify what he does. Now, he's making a big claim here where he's saying he wins 95% of his trades. Now, to qualify that, after doing some more investigation on him, it turns out that he is, I don't know, maybe 50% of the time writing naked options. Now, naked options are kind of, well, they're not kind of, they're extremely dangerous. And before I get into it, you really have to know what you're doing to write naked options. So I'm going to put a bit of a disclaimer out there saying that unless you know what you're doing, or unless you have somebody with a massive amount of experience, don't try to write naked options, because you will get your butt handed to you. Okay? Now, one of the reasons why I'm endorsing his particular style of naked options is because he seems to be mitigating the risk with adjustments. And he seems to be, when the market is dangerous, he writes a credit spread, and when the market is not dangerous, he writes a naked option. Now, I don't believe there's such a thing as not dangerous when it comes to the market. Anything can happen at any minute, right? There's always, when you're writing a naked option, you're always exposed. So my first caveat and my first warning to you: do not try to write naked options on your own. Now, if you take naked options and you add in my coaching, and I'll give you an idea of what I teach, just again to give you a bit of a disclaimer, I guess, if you will, right? If you take what I teach, now what do I teach? I teach you to, I'm all about value. In other words, on any asset, no matter what that asset is, there's always a good value. And what does value mean specifically? Value means that if you wanted to buy Tesla, there's a good price for it. But value is a tricky thing to find, right? And you really have to understand institutional order flow in order to find the correct value. So if I wanted to buy Tesla, would buying it, right now be a good deal? I don't know. Can you answer that question? Are you buying it because they've come up with some news about a car, or there's some new approvals that are taking place? Is $625.22? Sorry, yeah. Is that a good price? Or should you be waiting? Because if you overpay for it and the stock comes down to what I believe value is about $500 a share right now, right? Now, how did I come up with $500 a share? I think that if you buy Tesla right now, if you wait to $500 a share, that is the safest place where you're going to get a price reaction that should drive it probably back to 600, right? So if you're buying right now at 625, you you're overpaying in my particular opinion. And why do I say 500? Because I have a very specific way of quantifying that $500 is a very good value for Tesla right now. But what if you want to buy Tesla but you don't want to overpay and you want to get it at $500? You want to buy it at $500. Well, in situations like that, knowing how to write naked puts is an excellent idea, because you can get paid, right? You can get paid to write naked puts right now. You want to buy Tesla anyways, right? You're more than happy to buy Tesla at $500 a share because that's where you see value. So for whatever reason you want to buy the stock, but you don't want to wait for price to come down, why not get paid, right? And I'm going to show you something quickly. I just got this new software, Option Net Explorer, trying it on a trial basis. So if we look at the Tesla puts, right, and we look at the 500 strikes. Okay, let's go to the Tesla 500s. And let's go, let's say you go out 15 days. Maybe 50 days, right? You want to give yourself enough time. So if we go to the 500 strikes, we can see that the mid price for the 500 strikes is $9.77. I think that's right. Looks right to me. Yeah. It's $9. So let's say you wanted to buy 100 shares of Tesla at $5, at 500, right? Well, you can go and write this naked put at 9, and you collect a premium of $978. Does that make sense? So in a worst case scenario, if Tesla drops to 500, you're going to be put 100 shares, but while you're waiting for that good value, you just got paid $1,000 to do nothing. Now, let's say that Tesla, for free, let's say that Tesla over the next 50 days comes down, doesn't quite get there, goes higher, goes here, goes here, and your options expire. Well, guess what? You get to keep that entire premium, right? So you just got paid $1,000 to write that naked put. Now remember, what's the worst case scenario? The worst case scenario is that Tesla comes down and through your 500 strikes. But you wanted to buy it at 500 anyways. So you wait it out. And then finally, Tesla does what you hope it's going to do and goes up to $700. But rather than waiting around for value, you got paid $1,000. And let's say that Tesla, you love Tesla, but let's say that Tesla goes in a range. For the next year. Now imagine writing $1,000, $1,000, $1,000, $1,000, $1,000 over the next 4 months. Does that make sense? right? You just got paid $4,000 for nothing while you were waiting to get your value price on Tesla. So this is the only situation where I'm a big believer in writing naked put options, right? Now David has his own way of doing it, right? But I think if you combine, maybe David's way of doing it and my way of doing it, where you know where value is on every single stock that you want to own. And I think that as long as you're okay with owning that stock, or you're able to make an adjustment. Like, for example, let's say that Tesla comes down to 500, but something big happens. They find out that hydrogen is actually a better vehicle, and Tesla blows through that, right? You better, and you don't want to own the stock, right? You don't want to own the stock. Well, you better be able to adjust. Like, for some reason, when you get to the price that you want, you better be able to adjust that in time. And I think probably that's why that's more of what David does, where he really isn't interested in owning the stock. He's more interested in making an adjustment without owning the stock. But I think if you combine the two, the bottom line is if you know where value is on every single stock that you're trading, then you're going to be a superstar trader. And if you don't know where value is, meaning that what's a good safe price to pay for any stock, both long and short, then you need to take my course, right? That is what I teach. I teach you to always look at every single stock and to figure out where value is. So that when you buy it, no matter what the stock is, when you buy it, you're getting it at a price that the institutions are happy to own it at, right? That is the secret sauce to all trading. The secret sauce is to understand where value is. Are you overpaying or are you underpaying? So that being said, that is what I do. Now David does it a little bit different, and we're going to play his interview right now with him. But if you want to combine our strategies, which I think is absolutely the best thing to do, then I think you'd have a double banger. So what I'm going to do is I'm going to play the interview with David. If you like what he says and you don't want to own the stocks and you just want to make adjustments, head on over to his website. I'm all for that as well too. But if you combine the two of us, I think you'd have an incredibly powerful strategy. So right now I'm going to fire up the interview with David and play it, and I'll also put a link to David's website in the description, and yeah, there you go. Hang on, I'm going to start the video for the interview right now. So we all know that the risk is unlimited when we're talking about naked options, to a certain degree. The worst case scenario is you get put to stock, right? Now, I don't think that's a bad thing if you're happy with the stock that you're put, right? Now, I have a client that, just to give you a little bit of background about me quickly, and then I'll ask you the specifics that I want to know with you, because we all know that the real secret, the genius behind options trading is the adjustments. Mm-hmm. Okay? Any fool can put the trade on, right? Any idiot can do that. But it's the genius trader is not coming up with a trade that is, probability-wise an 85% chance that it's going to finish in the money, right? That's just Black-Scholes. We all know that math, right? So the genius in options trading is what happens when we roll, or what happens when we hedge it with a put, or turn it into a strangle, or whatever you want to do. So for me, from everything that I see you doing, which is basically buy and bottom parts of ranges um, is great. I think that's wonderful. But what do you think it is with you that specifically stops that catastrophe from happening once a year?
Yeah, I think what happens is when the VIX is trading below 20, then I know that while many people tend to be complacent, that is quote unquote the danger zone where people are throwing money into the market and there's a higher probability of a large pullback. So as a result, when the VIX is trading below 20 and there tends to be more complacency, during those times I'll switch to selling spreads, because what usually happens is that when there's a large volatility expansion event, and that usually transpires like once or twice a year, the VIX will pop from around 15 to anywhere from 25 to 30. And actually, this happened last week in the second or third week of May when the VIX fell to around the mid 15s. And then intraday, just like a few days later, it hit around 30. Now, I know that that specific day, maybe it was like last Wednesday or something like that. I know that it closed way off its high, but during those time periods, you have to be extremely careful because all of your existing positions are going to end up showing you a loss if you're short puts due to the large volatility expansion. And I think there's two things that I do. The first is when the VIX is below 20, I'll trade vertical credit spreads, because by trading defined risk trades, you're inherently protected against a volatility expansion, because even though your short put is going to be showing you a loss, your long put is going to compensate you for the increase in volatility, and it's still going to be defined risk. The second thing that I do is I tend to trade relatively far out of the money, and at the first instance or the first inclination that a trade is going to be in the money or is going to be challenged, I'll roll that position out and try to reduce my risk. So if I'm trading,
Sorry, say roll it out. You're talking roll it out not in time, but roll it out in price.
well, it depends. Like usually I'll roll it out in time. And if I'm trading a spread, which I usually am, because when the VIX is low, that's when you're going to get hit with a volatility expansion event in general, not all the time, of course. But what I'll usually do is I'll roll it forward in time and then use that premium to reduce the width of the strikes even more. Because what usually happens is, and this happens in like, March 2020, December 2018, people will be forced to close out their positions at a loss, usually at the worst possible time, only to then see 2 or 3 weeks later that the very position that they were holding, which they were forced to close out, would have actually been profitable. So it's really important to make sure that you do not run out of margin and that you do not run out of buying power. And like I said earlier, it is possible to win 95% of your trades, but to still lose money when you trade options, because those 5% of the trades, if you can, especially if you're trading naked options, you have unlimited risk. And what usually happens is you'll get placed into a margin call and be forced to close out your positions, and it can wipe out 2 to 3 years worth of profits. And the best way that I've seen to protect yourself is to trade vertical credit spreads when the VIX is trading below 20, because that will definitely protect you against a large volatility expansion, because it's different when the VIX is already trading at 25 and then it expands to 30. That's not really a big deal. But when the VIX is trading at like 13 or 14 and then it expands to 30, that's a really big deal, because usually when the VIX is trading at 12 or 13, you actually, when you open up new trades, you have to go further out in time to make it even worthwhile, because there's less available premium because everyone is so complacent at that time. And the second thing is I will roll the positions forward in time while also using that premium to reduce the width of the strikes at the first inclination that I have that the trade that I have on might be challenged and it might close in the money.
Yeah, yeah, and that's the secret sauce, David. Right? I mean that is the secret sauce. I mean, between you and me, I think it was 2010 through 2012, I was 100% winners writing verticals. And that's all I did. I had a very large account. I had a bit of a financial windfall. And if I had a lot of money, that's all I would do. But 2010 through 2012, I was 100% winners on verticals. But, like you said, when volatility came back in, it all it took was 4 months, and I gave back all of my profit because I didn't really understand, and it gave me a sour taste uh, about writing options. I didn't know back then that the real golden goose to writing options is the adjustments.
Yeah.
And one thing that I like that you do, which I think is really good, and you keep preaching it over and over in your videos, is that it don't be greedy because you have to have that flexibility to to adjust, and whether or not you're taking the stock and let's say you write a naked and decide, well, I like this stock, I want to own it. You have to have that ability to own it, and just I had a client of mine that was writing on these high flyers like GME and Riot and some of these EV stocks.
Yeah,
Well, he
that's
was
tough.
writing, yeah, he was writing these crazy stocks. He was writing all kinds of premium puts, and I was like, you're nuts. He's like, no, I'm really happy to own this stock, right? And a couple of times he got put the stock, but he owned it. And then when he owned it, he ended up writing covered calls against it because it's something that he wanted to own anyways. And so by the time he took in the premium on all the put writing, owning the stock, and then writing covered calls for a couple of months, he was breaking even on the trades that were absolute disasters.
Yeah, see that is a great strategy, and that's very comparable to like the wheel strategy where you're selling. I don't know if you sold like an in the money or out of the money put, but he's selling out of the money put. It gets assigned to him. He then sells a call. That's amazing. The only issue that I see going back to what we were saying before is that on those stocks like GME, and I'm not sure if it happened with Riot, but I know it happened with like AMC Theaters and also with GME. The margin requirements that the brokers were mandating were extremely high.
Yeah,
So if you were going
yeah,
to sell a call
yeah,
option on GME, even let's say GME was trading at like $250 at that time, if you wanted to sell a call option with a strike of even like 700, I remember just, and I think I did it in one of my trade alerts videos, where
yeah,
I didn't make the trade, but I just set it up to see how much buying power it would use. I think it used like 80 or $90,000, which
yeah,
from your client's perspective is actually okay because since it's using so much buying power, he is already not going to be placed in a margin call if he gets assigned. You see, the biggest problem is, like you said, when you're winning 95, 100% of your trades, you start thinking, or people in general start thinking, that why don't we be more aggressive with our trades? Because, hey, I can't lose. I'm winning 100% of my trades. If Amazon is trading at 3,200, instead of selling the 2,700, or instead of trading 5 contracts, why don't I trade the 2,900 and trade 10 contracts? Because I'm winning 100% of my trades. If I don't sell the 29, or if I don't sell 5 additional contracts, I'm losing out on opportunity costs and I'm actually costing myself money. And it's that type of mentality that long term successful traders, and I've lost a lot of money by being greedy as well. I had to learn the hard way. And that's why I preach it so incessantly on my videos, because everybody thinks that they're special until they get caught trading too large. And to be honest, winning all of your trades and getting complacent and trading too large and having that mindset that you're giving up money by not trading more contracts or trading more aggressively, that usually always ends up biting people in the ass. It's only a matter of time. And that's why I tell my students, And in general, that targeting around 3 to 3.5% a month is ideal. When someone tells me that they're making 5 or 6%, I don't say, wow, good job. I say, whoa, hold it. You're trading too aggressively, and that is going to come back and hurt you the next time the market has a relatively significant pullback. But from your student's perspective, he did it the right way because it used up a lot of buying power. He got assigned, and then because there was so much available premium there, as long as GME didn't crash, he could sell calls, pick up, probably $20 or $30 per call option, depending upon which strike he chose. And even if it went down, he would have a significant safety net because he already collected so much premium on the put and the call side. But if he traded too many contracts, then it would be a different story. Then his broker would force him to liquidate it.
Exactly, and to some degree, listening to the broker charging that much, or charging that much margin is a godsend.
Yeah,
you should really thank this broker.
It protects you against yourself, and a lot of people do tend to be self-destructive. They do, and in that respect, by increasing the margin requirements, it did probably help him out because when he got assigned, it probably didn't decrease his available buying power any more than selling that put or call option did.
Exactly. And so a little bit about what I do, and I do have another couple of questions for you, but just so you understand where I'm coming from. My whole thing is value. Okay, I'm a value trader. Okay, so the richest man in the world, he's a value investor. I'm a value trader. I just believe there's value in all time frames. Okay? So there's value on a 1 minute time frame to a short-term algo or a short-term market maker. There's value on a 15-minute time frame. There's value on a daily time frame. There's always a value price in relationship that is relationship-wise to the time frame that you're fractally trading, right? Now, like you, I've had a big problem with the entire options education industry because they're all telling you the math, the Greeks, all the math to play the probabilities, and I keep telling them, you guys you're missing the entire boat. Until you can get the right value right and direction, you have to get direction right. I don't care. The math won't save you unless you have a deep pockets. The math isn't going to save you. Like you can play. I think when I was doing my credit spreads, I was playing 80% probabilities about the money, right? Or greater in some cases, right? But even those spreads, when the market changes aggressively, you're gonna get your ass handed to you, right? Unless you know how to adjust. So for me, price and direction is everything. And there's always a right price and there's always a direction. So if you can get direction right as a generalization, meaning that you have a long bias on the market and you're either aggressively long on it, you're moderately long on it, or you're passively long on it, you can develop a strategy around that. And I don't care what the asset is, everything has a good value, right? It doesn't matter if you're following 5 stocks like you do, or if you're more, what I do is I'm a big searcher. Peter Lynch said it very well, and he said that the trader that turns over the most rocks finds the fattest worm. And I'm a big believer in that. Now, I also respect what you do because I think there's some truth to knowing 5 stocks very intimately. And if you can really know those 5 assets, that's okay too. But I think you go one way or the other. I think you have to be a specialist on something, or you have to go out and find the best value that you possibly can find. So where I think where we have some synergy is that we don't buy unless we get our price.
Right.
And we don't short unless we get our price.
Mm-hmm.
and it has to be the right price in the right context to that asset and relationship to the overall market.
Yeah,
So
that's very well
you
said.
and I are very, very similar in our thinking where if you don't get it, you don't participate. It's just that simple. You wait. I have a different philosophy than you do, which I believe that there's always a deal out there. I just got to go and search for it. And if I'm willing to do the research, I'll find it, right?
Mhm.
There's always a bull market in something. There's always a bear market in something. Even during this raging 12-year bull market, I've been shorting 80% of the time, and
Wow.
I've been doing great because I'm not just shorting anything. I'm going and finding those things which are really underperforming because I'm more of a short sale specialist. I'm better at short than I am at long. I don't know why. I just always have been.
They
But
say that short
yeah,
sellers are more sophisticated because they're more knowledgeable.
right. So my question for you, which is really interesting, is because I already recommended you to all of my students. I said, look at take what I'm doing, apply it to more of a swing trading approach, but go watch this guy's videos because I think this is a great way. Like a lot of times right now, if I'm waiting for value before I get long or before I get short, why not get paid to wait? So that's why I think what you're doing is brilliant, right? I think what you're doing is brilliant because you're literally, you know, a market's either random or it's trending, one of the two, right? And in a lot of random conditions, like you just have to be patient. So why not get paid to be patient?
Right.
And I think there's brilliance behind that, right? Again, so my question to you is that what do you do when like how many trade I kind of watched some of your videos where you were showing your trades and your trade adjustments, but I really wasn't sure. Would you say that you're putting on one trade a week or you're putting on like a couple trades a day? I couldn't really tell.
Yeah, that's a great question. Usually I'll put on like one or two trades a day. However, of those trades, I usually put on a new opening trade like once every 2 days, and the remaining trades will be adjustments. So, for example, let's say I'm short a put option of Amazon with a strike price of like 2,400 and it expires next week. What I'll usually do is I'll buy back that short 2,400 put, roll it forward in time by a week, and then make a decision whether I want to increase that strike price to about 2,500 or leave it where it currently is to collect more premium. And my decision on whether I'm going to increase the strike price or leave it where it is going to be determined based upon my perception of the overall market. How has Amazon acted over the past week? Is it trending up? Is it trending down? Is there a lot of fear in the marketplace? Is there a lot of complacency in the marketplace, etc.? Another thing which is interesting, and it goes back and harkens back to what you said, where both of us are focused on value and getting the right price. If, and I know Amazon on Friday, I think it was like May 9, no, May 21st, I believe. I'm not 100% sure if that was a Friday, but Amazon fell around $45 that day. So I think right now that Amazon is a pretty good opportunity. So tomorrow on Monday, if the market opens down and Amazon is down, even though I already have a relatively large position on an Amazon, I have no problem selling an additional put option because I believe that Amazon right now represents a great value. And if I'm selling a 22 or $2,300 put, I have no problem owning Amazon at 22 or 2,300, considering that its 52-week high is about 3,500 and I think $54, something like that. So
Yeah.
going back to what you were saying, where it's value, I will sell a put option at a strike price that I don't believe is going to get challenged. But if it does get challenged, I don't have a problem owning it at that price.
Okay. Okay, that makes sense. And so you're fairly aggressively managing your positions, like on a day by day, week by week basis.
Yeah.
You're not really putting a trade on and just letting it play out unless it starts to get challenged. As the days progress and as information comes in, you're adjusting those positions and maybe rolling deeper or doing. Now, is rolling your only adjustment? I did notice that you turned a couple trades into strangles or straddles.
Yeah. So typically, what I'll do also, and I don't really like selling calls on oversold stocks because what usually happens if a stock is oversold, especially if it's a market leader, it will usually increase in value and almost like shoot up like a rocket. So when I'm selling a call option on something that is already beaten down, I want to go very far out of the money on the call option to make sure that I'm being compensated for the risk of having the underlying stock fill in that gap and increase in value very rapidly. The problem is when you go very far out of the money on a call option for a stock that's already been beaten down, you don't really collect that much premium. So I will sell call options, but it's pretty selective. I might do that on a third of the stocks that on a third of the stocks that are challenged, but I will only do it in special cases where I don't believe that the underlying stock is going to rapidly increase in value because the last thing I want is to have the stock increase and then get challenged on the call side.
Yeah. Question to you is, what do you suggest that because as I you know, not too many people have 100K lying around, right? In the retail world, they just don't, right? And to do what you're doing to make sense, to make a living from it, and to be able to be a full-time trader, I think realistically you have to have a $250,000 account. I mean, that's if you live in Canada. I mean, if you live in any Canada and close to the GTA where I live, you know, $10,000 a month just doesn't cut it. I mean, that's not. You need at least $12,000, $13,000 a month, and not too many people have that type of money. So, and finding funding for options, with the exception of SMB, there's no prop firms out there that really will touch you. It's SMB will do it, but SMB is kind of tricky because they really want to train you in their way of doing it, or kind of the John Locke method of doing it, which I don't know if you know who John is, but John Locke's another genius options trader. If you don't know who he is, look him up because he's very very good. Um, but So, what do you tell people that want to do what you're doing or want to take your course and have like a $10,000 account? I mean,
Yeah,
to
so
to
I don't.
exponentially grow that, you're talking like 5 to 6 years, which in some cases might be fine, but for a guy that's 40 years old and wants to retire in 10 years, that's not a realistic type of thing to do. So, what's your answer to them?
So if someone has $10,000, I don't encourage them to take the course because the course it's not cheap, and I don't think it's in people's best interest to spend 18, 19% of their net worth or of their trading account on an education course. What I do sometimes recommend is that they take the trade alerts for 7 days and then they cancel it. So at least they get some type of exposure to options trading during those 7 days. I also encourage them to watch some options trading videos, either on myself or someone else who I also respect, like In the Money or Project Finance. So that way they learn the basics. And sometimes I do recommend that they join the alerts for like 1 month or a maximum of 2 months and then trade on their own. I think it's really important because it doesn't make sense for someone who has $10,000 to continually join the alerts because the fee from the alerts are going to end up using up all of their gains. But I do definitely think that you don't necessarily need $200,000 in order to make a living from it. I think that each person is unique. So as long as someone can factor in earning like 3% a month, then they can do the own calculation and make the decision on how much money they would need in order to earn a living. However, sorry, my son is here. Um, I do think it is really important that people do not try to earn more money than the 3 to 3.5% a month, because if they do that and they take too much risk, then they are going to end up losing money as opposed to earning money. So
Yeah.
yeah, I do definitely think that earning, like if you have below like $10,000, it really doesn't make sense to consistently join the alerts. The alerts make sense for someone who, if you have about like $20,000 to $25,000 and you can do it for about 3 to 4 months, and then I still think that you should do it on your own. But really, it's up to the individual to do the calculation and figure in how much money do I need to earn a year, and then back solve it and figure, okay, I'll make like 3% a month. I also, and this is the last thing, I don't believe that it's a necessity for people to trade full time, because I know that when I was trading full time, I got really bored, because even making like 2 or 3 trades a day and trading on my phone, I felt like really empty. Like even if I was making good money, that's why I started beststockstrategy.com, because I just got really bored and like felt really hollow. It was like, okay, I'm making another trade. Now what? Now what do I do? And maybe you feel the same way. It's like, okay, you're trading, but you want some type of human interaction. You want to do something that's productive. So I do think that many people can trade part time and don't necessarily have to have it as like a goal to especially if they have less than like 150,000 or $200,000. They don't. I don't know if that should be the goal, to be a full-time trader, because when you are a full-time trader, at least from my experience, it's actually quite lonely.
Yeah, well, I concur with that. I mean, I join all kinds of chat rooms, and I'm on Discord with different groups, and that's one of the reasons why I day trade, right? And we have a bit of a difference of opinion there, but you know, like I said, there's always everything's fractal to me in the markets, right? What Warren Buffett does on a monthly chart. Floor traders used to do intraday, right? It's the same thing. You buy good value and you sell high value, and it's just that simple, right? And so, for me, you're right. Being a full-time trader, just doing a couple of trades a day would not be an exciting thing to do, and that's why I day trade, because I just prefer not to be in the market overnight. Number one, and number two, I just prefer to be more active during the day. It keeps my mind occupied. Half of trading for me, anyways, is the mental stimulation and challenge that we get from it. You know,
Yeah.
so, but I definitely think there's a big place for somebody like you with a lot of guys. Like I have a lot of guys that are working full time. And so guys come to me, they're working full time jobs. They make 250, 300K a year, and they want to make money from the market. They want to outperform the indexes. They want to outperform the averages. Um, they like the challenge of trading, but they just don't have the ability to sit in front of the screen. So I think that there's a big market there for those types of people that do want to trade, and they can put in an hour or two a day, but don't have to be actively involved, right? So
Yeah.
that's a really big market.
Yeah. You said it's very.
I have the opposite. I have these guys they come to me and they want to transition to full time trading, but they got full time jobs.
Yeah.
And
It's very difficult to do that.
yeah, I mean, I tell them, look I'm in front of my screen from 7 o'clock till 4 o'clock every single day. That's what it takes to day trade. I can't. Things can change so quickly. 4 minutes later, a raging bull market can turn into a massive sell-off. And if you're not there for those 4 minutes where that transition takes place,
Well,
from 4 hours,
and you're going to get caught on the wrong side, and it's just going to be a matter of time, and you're going to have a really big loss on your hands, right? So I think it's really good what you're doing. I think that again, if you combine it with what I do, I think it would be even more and more powerful because for me, I always know the context of the market, right? I always know, should I be aggressive? How aggressive should I be? To what degree should I be aggressive? Where am I right and where am I wrong? Because I always know where value is, right? Because value is a subjective thing, right? Value on GME, you know, you can really argue, and Bank of America says it's $12 a share, and I think Bank of America is right. I think eventually GME is going to go back down to $12 a share, but that is not the value of supply and demand.
Right.
That's
Yeah. Well said.
the fundamental value.
Mhm.
Supply and demand said it was, what did it get to? $1,000 or something, right?
Yeah.
So whatever,
I think five.
right? But you can't fight that
Mm-hmm.
because there was a time there where value was 100. There was a time when it was 200. There was a time when it was 300. There was a time when it was 400. And you had opportunities to capitalize on that because that was the value of supply and demand, period, not the fundamental value. So for me, I don't really care what the real value of something is. I care what the market says. The supply and demand dynamics of that market are saying where value is right now, right? So I'm going to continue to recommend your course to all of my students because I think it's a fantastic fit for some of them. Um, and yeah, like I said, I think a lot of the times if you're impatient, you might as well get paid to wait. If I'm looking at a stock and it's $100 right now, but I don't want to buy it until it hits 85, well, why not write naked puts at 85 till the cows come home,
Right.
right? I'm going to buy it at 85 anyways, so I might as well write. I might as well get paid to wait. I think that's the brilliance of it, right?
Yeah.
So, yeah. Anyway, did you have any questions for me or?
No, I think this was great, and yeah, I really respect everything that you're doing. I'm very glad that we had a chance to have this call, and I really look forward to introducing you to my students as well. So thank you so much for
Oh,
meeting
you're
with me on a
welcome.
Sunday. I really appreciate it.
And if any of your students want to come over and they want to learn how I do find value, and again, I want to stress, I am a day trader, but many of my clients swing trade. I just personally don't like it, right? Um, but I don't mind doing credit spreads, and I like the fact that you have a bit of a filter for the VIX when you decide when naked is good and when naked's not good. That's really good. Um, but for me, eventually I'm going to build my account to a large enough size, and if I had a multi-million dollar account, which I don't, right? But if I had a multi-million dollar account, I would be doing nothing but what you're doing. That makes a lot of sense to me,
Yeah.
right? It doesn't make sense to me to be an aggressive trader. I think being an aggressive trader on a 1 minute time frame or 50-minute time frame is really good for building your account higher, right? And I really want you to really, I know you don't like day trading. I know you had some bad experiences with it, and I know you don't think it's possible, but it is very possible.
Yeah, I've softened on my thoughts regarding day trading like over the past 6 months. So yeah,
Yeah,
I don't have a problem with it.
yeah. And I'm not saying, like, I saw some of the videos that you made of some of those guys that were, doing those crazy option spreads, and I happen to agree with you with those particular people that were, claiming they were making $2,000 a day. And if you watch their videos, it's insanity because, they'll buy five Tesla puts on a breakout, and then on $100 stock, they'll buy 5 calls or puts on that. Their risk management is completely nuts because they're just buying number of contracts. You
Yeah,
get you get caught upside down on one of those 5 trades. It's a lot different getting caught upside down on $100 stock with 5 contracts than it is getting caught upside down on a $500 stock with 5 contracts.
I completely agree.
If any of your students want to come and learn how to find value the way that I do it, aggressive, moderate, or passive, I'll give them a 33% discount if they tell me they came from you. Okay, so if they're interested, just email me. Say I came from David. I'm happy to give any of your students a 33% discount.
Thank you so much. That's amazing. So thank you so much. I really appreciate you spending the time with me on Sunday. And yeah, this was a very valuable video as well, a very valuable interview.
It's really nice to talk to another trader that I have respect for.
Thank you so much.
Okay, guys, so that's the end of that video. And if you like what we talked about, head on over to David's website. I'm going to put a link in the description because I became an affiliate. Why not, right? Make a little bit of extra money because I'm also offering his students a 33% discount on anything, any one of my products. And I want to stress that if you want any one of my products at a 33% discount, email me at Steve Patterson Trading. Mention David in the email, and I'll send you a custom invoice for that. Hope you guys enjoyed that. I really enjoyed my chat with David, and hopefully we'll become closer friends in the future. Love you all. Bye for now.